Okay, let's go ahead and jump right in. I'm Sarah Layton with Connecticut Resource Conservation and Development. I'm the Agricultural Programs Coordinator. And through our Connecticut Veteran Grown Initiative, we're really excited to be bringing this training today, the basics of farm taxation. Just a couple of notes before we jump in. This is our fourth training that we have done this year for Connecticut Veteran Grown. They have all been recorded, as this meeting will also be recorded. And they will all be available on our CT Veteran Grown YouTube page as well as on our website. So if there's anything that we go over tonight that you want to rewatch, you're welcome to check those out once those are posted, or you can look at the other meetings as well. We do have two more webinars coming up on February 4th. It's a pre-recorded webinar that is direct to consumer marketing. And on February 11th, we have a pre-recorded webinar on the Canva 101. So if you're interested in either of those, you can register and you will get a link once those are posted and live. As I mentioned, this meeting will be recorded. You're welcome to ask questions in the chat. Andrew is great at addressing those as we go, but he may need to wait on some of them until the end of the meeting, or he may need to email you an answer if it's a little bit of a longer or more specific question. And without further ado, I'll introduce Andrew Desiderio. He is a senior tax specialist with Farm Credit East, and we're so excited to have you tonight, Andrew. Thank you very much.
Thank you, Sarah. I appreciate it. As Sarah had mentioned, this is meeting 4. Last week we had a meeting or a webinar based on accounting, farm basics of accounting. So this is kind of taking a step further with taxation. Some of the concepts are being brought from that to this. So if you haven't seen the accounting one from last week, I would recommend going to YouTube and watching that. So this, our webinar is going to be based on taxation, the basics of it. And so some of the topics we'll be talking about today is what exactly is taxation, some of the common types, some exclusions, exemptions, most common and frequently used tax forms, some of the filing and reporting methods, representation, and some additional resources that can be used. So over the next hour or so, we're going to be talking about the basics, the fundamentals. This is by no means going to encompass every single thing that a farmer or a new farmer comes across. This is the intent and purpose is to kind of give you exposure if you haven't seen or heard of a lot of the topics that we go over. It's meant to be, kind of a refresher or, expose you to some of the topics that an accountant or maybe a neighbor or a colleague may, communicate with you. And if something does interest you that you want to go deeper on, let me know, and we can chat or have a side conversation. A lot of these topics can go very deep very quickly. So I tried keeping this very high level. So with that, what exactly is taxation? So if you don't know what taxes are, basically it's a levy administered by federal or state government for a financial obligation to its residences, citizens, or actual entities, corporations, partnerships, LLCs. So you may ask yourself, well, why? Where does this money go and what is it for? There's a lot of different types of departments within each government that it goes to. Our defense, our military, our highways, our streets, our roads, the police, the courts and the justice system, Social Security and Medicare, the taxes that the FICA, we'll get into Social Security and Medicare, Obamacare that came out, or Affordable Care Act, a lot of the taxes pay into that. There's a lot of refundable credits. Earned EIC stands for Earned Income Credit on the federal side. There's additional tax credits, fuel tax credits that you pay when you go to the pump. There's a lot of grant funding for higher education. There's a lot of uh, state grants that help offset some of the costs of certain projects. I don't get too much into the grant funding, but just know that there are some grants that are funded from taxpayer dollars that are budgeted every year uh, by the state. Common types of taxes that you would come across as a new or beginning small farmer. The most popular one, income from W-2, your wages that you work either off the farm or on the farm. If you're working for another farmer, I would suspect a W-2. If you're not working for somebody else and you're working by yourself, that's self-employment income. Um, those are there's we'll get into the types of taxes. So we're going to break down, kind of go into each of these one by one. Payroll is probably it's one of the complex ones, and there's a lot of different types of taxes. FUTA stands for federal unemployment tax. State or SUTA is state unemployment tax. FICA is Social Security and Medicare. We'll get into capital gains and give you the basics of the types of capital gains and how those are taxed and treated. Give you a little bit of background on what they are and how they're treated and why they are the way that they are. A hot topic is sales and use. You get a lot of questions on sales and use. That can be a very deep topic. More common one is excise. So that can be broken out in a few different areas. We'll get into the types of those. Mostly seen as property. Obviously, your vehicles, real estate, corporations, LLCs pay excise, or pass-through entities. We'll see that. Getting to the first one, the W-2. If you've never seen a W-2 before, tried highlighting the big areas that stand out the most. So this is someone who works for somebody else, right? So some may not realize that there are actually 6 copies of the W-2. When you normally, the most common way W-2s get filed is electronically through software. And so when you do get a W-2 from your employer and you go online, if you do your own taxes, a lot of the times your W-2 will get sent by your employer to all of these agencies. And when you file your tax return, you're basically, sending your information saying you're reporting this information. So a lot of the computer systems with the IRS and Social Security Administration and the state link up to all of these numbers and boxes. So the information that the companies help prepare these forms is pretty important. And likewise, when you or your accountant or someone else is reporting the information, it's very imperative that the numbers match up, because it's one big computer system that's matching numbers in dollars and figures. So you'll notice that the biggest thing is making sure that your data is correct. Your employee social security number here, or one of your employees, would be in box A. Employer identification number. So that's call it EIN, which is basically call it social security number of a business. So once you start paying employees, you're not going to want to use your social security number. You're going to want to apply for an EIN number. And you can do that on the IRS.gov website. And then you would have your employer's name, the address, the employee's first name and initial. I'm not going to get into the different types of wages, but just know that different wages are taxed differently, and there's different types of taxes that get withheld from your employees, and they go to different places, right? So on the right-hand side, you'll notice box 246, 8 are basically, or 246 are your three different types of federal taxes, right? Federal income tax withheld, Social Security tax, and Medicare tax. And then on the left-hand side, 1, 3, and 5 are the federal wages. So there's three different types of federal wages, and there's different deductions that will treat or calculate those wages. Towards the bottom of the W-2, you've got your state wages. So more than 99% of the time, box 1 and box 16, your federal and your state wages should be the same. There may be a slight difference for one or two other reasons, but for the most part, they should match. And then you got your state income tax. So that's the amount of the withholdings that get reported to the state. So in a nutshell, this is for you working for somebody else and how your income gets withheld and taxed. And then you would then go file for either a refund, or maybe you still maybe you didn't have enough withholdings taken out of your W-2, and then you would have a balance due or a liability. But it all starts from here, after you get paid, obviously. Um, and then you'd have all these different. So at the very bottom says copy 1. You would see one for copy 2, copy A, copy B, copy C. I'm only showing copy 1, but you would in reality, if you look at your W-2, you would have, well, the employer would have theirs, but you would have two states, one for federal, and one for your records. So the employer would have theirs, and then basically all the other ones for their records as well. But if you're looking to pay employees, just know that you would have different copies for each type. Getting further into taxes and the income, taxes are not, your income is not taxed at one flat percent. The purpose of this chart is to show that there's a tiered system and there's a bracket of income for each tier. So when people say I'm in the 24% tax bracket, that doesn't mean all of their income is taxed at 24%. That means that only if there's someone is single, then the amount between 100,000 and 191,000 was taxed at 24%. If someone made, let's say, 80 or $50,000, they would be paying 10% at the first 11,000, 12% between 11 and 47,000, and then anything above 47 up to 50 would be at 22%. So it's a graduated tiered system. It's not a flat tax for all of your income. The only ones that pay a flat tax are corporations, C corporations specifically, at 21%. So individuals are at a graduated tiered system, and I'm showing single and married. There's qualifying or a head of household, and there used to be qualifying widower, but now that's head of household. So there are 3 tax filing statuses. Right now, I'm just showing the brackets for single and married, but just know that there are more filing statuses based on different criteria of your tax situation. So if you're not working for somebody else and you are working just for yourself as a sole proprietor, sole meaning solo, proprietor meaning in control, or managing or running your own business. In the terms of the IRS, what does this mean? So if you are selling or providing goods and services, and which cannot be classified as wages because an employer-employee relationship, meaning you're not working for somebody else, there's no relationship with somebody else that is controlling the work, then you are deemed as a sole proprietor. You're in business for yourself. So who may this be? This can be machine operators, can be contractors, professionals, freelancers, farmers, right? They're in business for themselves. There's no other relationship with somebody else that they're working with. They're working, for themselves, or they have employees working with them. If you are in business with another person, then you could be a partnership, right? Two or when there's multiple sole proprietors that are working together in one entity, that's multiple proprietors or partners that are conducting a trade or business. In that case, they'd be getting a K1 from the entity. This meeting is based on sole proprietorship tax. So a lot of it's going to be general Schedule C or Schedule F information. Self-employment income limits and rates. So when you are in business for yourself and you're a sole proprietor, the tax is based on your net earnings. So last week we went through the profit and loss and showed you've got gross revenue, all the monies that you earned, all the sales or services you provided, less your expenses, right? And then the expenses are the operating expenses, not the loans, not all, it's what you paid to operate your business that got you to net expenses or net earnings, excuse me. So you pay tax on the net earnings that are anything more than $400 of net earnings, net income. That's the minimum threshold. It's very low. And so that's what the IRS says. Okay, at that point, we're going to tax you at 15.3. So on the W-2, you saw Social Security withholdings and Social Security tax and withheld. As an employee, if you're working for somebody else, you're subject to those same taxes. And likewise, as a sole proprietor, you're subject to those same taxes as well. It's just the IRS is taxing it a little bit differently. It's on the net earnings of what you make. Now, Medicare and Social Security tax have different rates, 12.4 for Social Security and then 2.9 for Medicare. There's a limit on the total amount of earnings that you will pay on Social Security, and every year it's adjusted for inflation. For 2024, the cap is at 168,600. For Medicare, unfortunately, there's no cap and it's unlimited. Actually, once you exceed 200,000 for single, there's an additional tax of 0.9%. If you're married, it's 250. So it can be up to another almost 4% with additional Medicare tax. Social Security is capped at 168, but Medicare will keep going. So payroll taxes, if you have employees that help you work on the farm, as I referenced on the W-2, as an employer, you have to withhold federal and state withholding, Social Security, and Medicare. There are two other taxes that the employer is subject to that the employee is not. And that's federal unemployment and state unemployment. So federal unemployment is just an employer-only tax, and it's based on a set amount every year, and it's essentially there's a limit that the employer will pay into per employee. The purpose of this tax is it helps provide compensation for employees who are out of work or lost their jobs. State unemployment is essentially the same mechanism, but just administered by the state. And there's different limits that the employer will pay on a per employee. Federal federal unemployment is $7,000 per employee, and it's based on 0.6% of each 7,000 of wages. So once someone hits $7,000 of wages, the employer is no longer subject to pay tax for that employee for that year. Connecticut, I believe it's 15,000 per year. Um, so the calculation can get pretty technical pretty quickly. The purpose of this is just letting you know that if you do decide to go into hiring employees, expect to be paying your share of Social Security, Medicare, as long with federal unemployment and state unemployment. So the employer is responsible for calculating, withholding, remitting, and administering all of the taxes. There are some exemptions for ag production. I'll get into that in a minute. Um, Depending on what type of work is being done, is considered ag production. Um, and there are thresholds that you can be exempt from federal and state unemployment in Connecticut if you are considered an agricultural employer. I'll get into that next. This is directly from the Department of Ag. I have the link here if you wanted to screenshot it or go take a look at the code. This is I'm not going to read all this because this is very wordy and the definition is very wide and deep. And basically, in a nutshell, it's a lot of different types of agriculture, farming, aquaculture, horticulture, forestry, nursery, livestock. It includes a lot of diverse agriculture. And I would recommend, checking it out if you're thinking about going into payroll and hiring other staff to help manage your business. There are some exemptions that could help you save on taxes, specifically federal unemployment and state unemployment. Um, Payroll is probably one of the most complex and easily um, miscalculated taxes in agriculture, because it's so complex and it's very easily to get a notice or file incorrectly. It can get very, very ugly quickly. So I recommend working with an accountant or working with a third party professional who understands payroll, especially with agriculture, because there's a whole separate set of books and rules, and it can get complex if it's not being calculated and treated properly. One of the next things that you can come across is capital gains. Capital gains is where so we talked about income from a W-2, income if you're a sole proprietor. So when you're in business and you're selling and making money, you're making money from selling your product. Capital gains comes into play when you're selling tangible property or assets. So last week we talked about on the balance sheet, you have assets, liabilities, and then equity or owner's equity. So on the balance sheet, you have your assets. So machinery, equipment, real estate. Real estate can be buildings or land, right? Any structures that you have on your property that's not equipment or machinery, that's structures, or any improvements that you have. If you have solar panels and stuff like that, or stocks and bonds that the company may be investing in. Certain types of livestock, if you're a dairy farmer, depending on the type of cows that you have, or if you have, if you're equestrian, some of your livestock can be capital gains, depending on holding period. So capital assets get different tax treatment, and these are called preferential tax treatment. And there's 3 tax rates, 0, 15, and 20. The big difference between capital gains is holding period. And so holding period is the number of months that you held the asset from when you acquired it. Anything more than 12 months from the date of purchase or from the date that you acquired it is called long term. And those get the preferential tax treatment. Anything that's 12 months and less, so less than a year, would be considered taxed at your ordinary income. And so on one of the previous slides, there was rates between 0 and 37%. And so if it's short term, whatever that gain will be taxed at those ordinary rates. If it's long term, more than a year, how you figure out where that gain income gets taxed at, you take your regular taxable income, and then you add whatever. Say you sold a machinery for $10,000, take your $10,000, add that to your regular income, and then you figure out, okay, where does that lie in this grid, whether I'm single or married, and that will give you your capital gain tax rate. So it's a separate set of tax rates for a specific type of income that's separate from your normal operating income. They're very, very tax friendly, depending on what rate and bucket you fall in. Okay. State sales and use tax. First, I'll start off by saying when thinking about sales and use, the best way to look at it is I'll start by saying most of everything is taxable, and then they get to exceptions or exemptions. It's easier to work from the front and then go backwards because mostly everything is taxable in the eyes of the state. So if you're selling goods, if you're renting goods or leasing goods, product, it's mostly taxable with exceptions. If you're providing services, it depends. But operating a hotel, motel, lodging, or a bed and breakfast establishment, 6.35 is the rate. If you're in Massachusetts, it's 6.25. It can get a little complex if you're on the border and you do some sales in Massachusetts and some sales in Connecticut. You do have to do both. You have to register in both states. I'm just going to talk about Connecticut because this is where we are based. So there's a lot of exemptions, and this is not an all-inclusive list. If you want to see the whole inclusive list, I gave you the link there, and if you want to go check that out, it's deep, and there's a lot of other items that are non-taxable. So some of the major ones that we come across are in ag production. Before you even so there is an ag farmer tax exemption permit that farmers can apply to have if you need to go buy items for your business from another farmer or from a store. You can apply for a farmer tax exemption permit through the state, and that is issued on a 2-year rolling period. It does go based off of the definition of ag. You have to be in business and meet one of those qualifying criteria to apply for that. So the point here is that there are permits available to farmers that you can use in purchasing goods and services for your business that can help you save about 6% on your product, on your goods. So what may be some of those things? If you go to the grocery store and if you go to the produce section, right, food for human consumption. So what is that? So anything that is prepared or packaged that's ready to eat right then and there, then that's going to be taxable. Any candy in a vending machine, alcoholic beverages, carbonated beverages, food that's ready to eat right now, that's been prepared, that's going to be taxable. Any other food that's for human consumption, produce, vegetables, those are going to be non-taxable. Even the even the seeds themselves, if you were to go buy seeds from a store and you're going to go plant cucumbers, tomatoes, peppers, and that those are for human consumption. They're in raw form, but essentially there's no tax on those. Likewise, if you are growing produce, raising produce, and you are selling to, let's say, Big Y, you are a wholesale. You are growing for wholesale. The proceeds, the sales that you generate, and you're selling it to someone else who's then going to resell it. The point of sale, when that customer goes to check out, will pay tax on that item. So if you're a wholesaler, depending on what you're selling, can be sales tax exempt. Another common item is bulk foods, bulk sales of foods. Whole loaves of bread, cakes, or pies are considered bulk and are non-taxable. So most other goods, so flowers, decorative items, are taxable at 6.35. So that's why I kind of started with mostly everything is taxable, and then backed it off with these are the exemptions that are excluded. And then the meals, I left this link here, and you can Google very quickly, you know, sales tax exempt items. There's a whole booklet or PDF online about through Connecticut DRS, Department of Revenue Services, that goes through, and you can click through. It's like an index, each section, which I thought was it's updated pretty currently, regularly too. Personal property taxes. And so this slide is basically on the other types of taxes: personal property, excise, and PA 490. PA 490 is a public act that was passed in 1963, and it's specific to agriculture. It allows for farms, forests, and open space lands to be assessed at a lower value versus a fair market value. So you apply through your town. So this is town by town. And if you're looking to go into farming or thinking about going into farming, um, this can be a very, very beneficial exclusion that can help you save on real estate tax. So this is based on the land or open space on the property. So most residential or not commercial are they're taxed on the fair market value versus what the town assessor will say. They'll go to your farm and they'll see what's the highest and best use of your property, and then they'll assess what that rate will be, and it'll be very different than if someone wants to go put up buildings or a strip mall in open space, because they're going to assess it at different rates. PA 490 is a different rate. It was written to encourage preservation of farm, forest land, and open space. It's a one-time it's by person. So if you decide to sell that property, the next owner would have to apply. So it doesn't go with the farm. And so you'd have to reapply again. But it's a one-time application. You don't have to renew it like your sales tax permit every 2 years. There are consequences if you do sell that property before 10 years, because you are getting a discounted rate. But after 10 years, I do not believe that lien, or it's not a lien on the property, but that conveyance tax, it does not apply. Going back to the other, I kind of started out of order here. Personal property taxes is basically on the tangible property. So not thinking about the land, but let's talk about the machinery, the equipment, some of the buildings, right? Personal property, tangible property. This is also administered by the town. There's an actual form that gets sent out every year. It's due by November 1st. and you categorize all your assets, your personal property, machinery, equipment, I think unregistered vehicles, um, and you go through and list, and the exemption can be up to 100. The first 100,000. Once you get to your total of all your property, if it's say it's 500,000 of your property, you get $100,000 that gets taken off, and so you'd only be taxed at 400,000. There are some criteria to qualify. You must show that you're 15,000 in gross sales or demonstrate 15,000 in expenses. If you can't get that and within the first year or two, I've heard good stories from working with the towns that you can work with them and show they'll work with you if you can't get there. And um, you know, I would just say go check out and talk to your local town assessor, your town hall. I've heard good stories that have come from working with your town, especially for young, beginning small farmers just trying to get uh, into the town. The other common one, if you're not into farming, is your excise on your motor vehicle. You can register your vehicle to be farm, where you would be basically excluded. If you're not, then you would be paying on the mill rate of the vehicle, which gets changed every year. It's kind of the most popular one is your motor vehicle tax. If you don't know what that is. Getting into the form types, there's quite a bit of forms. I did download each form. I'm not sure if we'll go through. We're not going to go through every single one of them, but I did kind of bring up each one of these just to show you what it looks like if you come across, if you're an accountant or if you're looking to do your own taxes. These are kind of the most popular ones that you would have if you came across either preparing your tax returns or if one was prepared for you. And if a bank or someone was asking for, we need, or what most common time these forms come across is applying for workers' compensation. The insurance companies will say, show me your 941 or 943 from last year, or show me your 1040 or Schedule F. When you apply for a farmer tax exemption, you will have to provide your Schedule F, and the town or the town, the Connecticut will want to see what you're grossing to be exempt, and likewise. So um, here is your let me know if you can't see, if these don't show. Page one, your 1040, it's going to list all your income. Page two shows basically all the taxes, your payments. If you have a balance due or refund, who prepared it, and then obviously your signature. There's a lot of other forms that go. Your page one and page two are summaries. And so a lot of other supporting schedules are calculated, which flow to your 1040, page one and page two. Your Schedule F from last week, we were talking about your net income, your gross. So your farm income would be reported here. It would show all what type of income that you made, and your gross income would be displayed here. All of your expenses would be detailed here by line item. And if you don't have enough, if there's other expenses that don't fall in these categories, it doesn't mean that they're not deductible. That's why the other line is here, and you just state in detail what they were. Again, so this is your Schedule F. So if you're in business for farming, your income should show up here. If it's not, directly related to agriculture, maybe it's a byproduct or an ag-related business. Then we would get into the Schedule C. The Schedule C is basically every other business that is not farming, right? And so Similar concept. You've got your gross income, and then you get your expenses. Um, Pretty similar format. The only real difference is, it gets more detailed into the types of income derived from farming, right? Some cooperatives pay out distributions or patronage. You get some loans, special treated loans, and then if you're not selling goods or services, you may be renting land. Maybe you're a landowner and you're renting out your property to someone else who is actually farming your land. That would be a what the IRS calls supplemental income, or you'd be a renter or a landlord. So you'd be receiving rents. Um, if you have a gravel pit or any type of natural resource or mineral, you'd be receiving a royalty. And so there's a lot of gravel pits in Connecticut for stone or sand. This is where you would treat that income separately. The costs that are associated with that income would be listed here. If you have a mortgage on the property, if you have insurance, or if you pay someone to monitor it, or if you have type of repairs that need to be made, this schedule would be used for that type of income. It's not common, but know that they're out there. Capital gains. This is where you would report those sale of assets. 941 is for payroll for the federal. This is done quarterly, so you would report your wages by quarter. I'm not going to go through the details because this can get very complex quickly. 943 is your annual form for payroll, similar to the 941, but this is done annually for ag specific. If you have employees that are non-ag, you'd be using the 941. If you're 943, which is ag specific, you would be reporting on this one. On the unemployment side, whether you're ag or non-ag, this is where you report your unemployment information. For the federal, Connecticut, 941, this is your withholding. So the state withholding. So on box 15, we reported on W-2. This is where that information goes to the state. This is where you report your employees withholding. Connecticut has their own form for unemployment, state unemployment. This is done on a quarterly basis. You get a specific rate that's determined each year based on performance. On the next page, you report your employees, how much you pay them per quarter, the name of the employee, and their social. Sales and use. So depending on what you sold and when you sold it, you would report to the state your sales and the tax that you collected, and then you would remit that to the state. Depending on how much you make, will depend on how often you file to the state. If it's very minimal, then it could be once a year. If you've got more regular sales, it could be quarterly or monthly. The most common one's monthly, but it depends on how much sales that you generate, that you file and report to the state. The CT declaration. This is the property 100,000 exemption. This is where you would list here the type of assets that you have, and it's by year, and you basically work off your depreciation schedule and report how much of your assets that you have per category, and you multiply the math, and basically work your way through this schedule to help determine your basically net assessed amount per year. This you can find right online. It's pretty easy. A lot of accountants do it for clients, but it's something that you could do on your own. But essentially, those are the most common tax forms, filing and reporting methods. So um, there's more than one way to file. There are essentially some people that still do their taxes by pen and paper. I will say the state of Connecticut is enforcing more electronic. They're mandating more electronic forms. Can you still paper file? You can. I would caution that you may get a notice in the mail saying next year, please use e-file. There are a lot of forms. There are a lot of systems out there that you can use, that you can download or pay a subscription to. I would still recommend understanding some of the code or the law, just so that you know that the system, when you enter information, that it's going to the right form, the right spot. You're ultimately, I mean, there are some audit check features you can buy into that will help you. The liability is ultimately is on you, eventually. But I would just try to understand as much as you can. If not, work with a professional. Um, Third party professionals, enrolled agents, CPAs, accounting firms um, do this quite a bit. So if you're not wanting to do it by yourself, and you want to have a professional do it, just do some research. I know last week we talked about how do I go about finding a professional. What are some of the tips on finding a professional? The internet is your friend. A lot of companies have reviews. Figure out what industry that you're in. Ask the company, what sector do they focus in on that will be a good fit for you. See how long they've been in business for, if they have any referrals or reviews. Um, if you do go the route of working with a professional, when would be, if you're not doing it yourself and you come across to a point it's like I think I need some help here. When would that be? If you do your taxes and you do get a notice in the mail, um, highly recommended to work with a professional to help you get through the notice. If you get a letter in the mail saying, well, we need more information on your return, um, be cautious that some of these notices or letters are fake. We're seeing a high uptick, especially since COVID, of spam or phishing, where notices come across that are not legitimate, and they're asking for your information, um, to take advantage of your information. If you have a complex tax strategy, if you're looking at a new tax credit that's out there that's very complex, or if you've got a depreciation that's that's complicated, you may want to engage with a professional. If you're starting out, and you don't know where to start or how to do accounting, may want to reach out. The one thing I get a lot is we paid so much taxes last year and we don't know why. Tax planning can be a great tool to work with a customer, not just at this time of the year, or actually right now it's kind of too late, but after tax season, after April, during the summer, right before the end of the year, there's at least 3 times of the year that you can tax plan. And it shouldn't just be November or December or towards the end of the year. Said differently, if you want to look and see how you compare to last year or the year before, you can do a comparative analysis, and see, where you stack up from prior years. Or if you want to get to a certain point, if you want to grow your revenue, what do I need? A lot of customers say, what do I need to do to grow by 10%? So you can get into the details with a professional on profit analysis or gross profit margin. Retiring partner, gifting, that's more complex, but I put it on there because we do succession planning and gifting and that type of consulting. Other considerations, the IRS expects a profit motive, meaning um, you're in business to make money, right? If you consistently show excessive losses year over year, the IRS may come in and say you are not a trader business, you're a hobby, and they'll limit your expenses and make them almost non-deductible. Quick question came through the chat: is cordwood a taxable item for sales in use? Firewood, um, I believe. I'd have to look. I don't have that on the top of my head. I'll have to get back. I'll have to take a look. I know there's different types of rules for Christmas trees. There's different types of logged wood. I don't believe so, but don't hold me. I'll have to go take a look. Don't come across that one too often, but I'll take a look. There's also a tax credit for fuel that you buy at the pump that you use off farm. So if you have fuel that you pay at the pump and you're using it off farm, just know that there's a fuel credit, 4136 for off-road fuel. The net, there is a deduction for qualified business income. That's 20% of the net income. Another kicker is the the Trump Tax Act is set to expire next year. Those laws and regs are going to be changed, could be changed next by this administration next year. Keeping record, and we mentioned this last time, keeping records for at least 7 years, receipts, invoices, maintain a depreciation schedule for significant assets. If you have multiple assets, you may want to hire someone to help you manage that. 1099s, which ones that need to be issued, mostly for contractors, for rent, for interest. If you receive any 1099s, you're going to want to report that as income. 1099s can be a whole separate issue. Some helpful information for future reference. A lot of what I prepared this was from the irs.gov. CT My Connect. If you don't have an individual portal, that's where you would go to either file or get a lot of your information. CTDRS, that's Department of Revenue, Department of Labor, Department of Agriculture. VITA is a voluntary income tax assistance. It's administered through the IRS. There's a lot of retirees, a lot of college graduates, and VITA is a very helpful and very useful service. And I did a search on the internet, and basically what it is they're offices, and they're mostly staffed during tax season. And there's this free tax assistance. I believe it's if you make less than 60 or 67,000, you can get your tax return prepared for free. A lot of college graduates who are going through tax or accounting school, at least my college, required their students to participate in a VITA program for 1 semester. So I would recommend, if you're looking for questions or help preparing your tax return, I know there's at least one agent in that each office that's staffed by the IRS that help monitor and manage the attendees. So I would totally recommend VITA for anyone that's looking for free tax help. If you make, and also I think the other stipulation is if you're elderly, you get tax assistance, but it's mostly determined by income. So if you're under the 60 or 67,000 threshold, check out VITA. Libraries, universities, your town hall, Farm Bureau, any of the sponsors that help put on this meeting. I'll take a look at the cordwood. I don't come across it all that much, but I'll take a look at that. and I can email Sarah to pass on the response. But if anyone wants to email me directly, I'd be happy to answer any other questions that we had. Um, Sarah, or if anyone else has any questions, we'll stick around for a few minutes. But basically, that's what I have for today. Thank you for having me.
Thanks so much, Andrew. Are there any other questions out there? All right, we're all tax experts now. Sean and Kitty said they just found it on the CT Gov site.
Okay.
What did you find out, Sean and Kitty?
I want to say probably.
All right, if there are no other questions, oh, sales of cordwood by an individual who is
Yeah,
not engaged in forestry does not qualify for an exemption.
I didn't think so. I think like timber sales, I think they actually get what's a federal, but um, most of the things are taxable in Connecticut, and then there's some exemptions. So I didn't think that was going to be exempt, but I don't want to lead anyone down the wrong way. Just want to be safe and check it out first. So
All right. Well, you guys can always email me if you have a question or email Andrew directly, and this will be posted on our YouTube page and ctveterangrown.org. So you're welcome to go back through if you want to watch any of this again. Thanks so much, Andrew, for joining us tonight.
thank you, Sarah. I appreciate it.
Thank you.
Take care.